Imagine you just spent weeks, maybe even months, building the perfect AI trading bot. You've coded it, you've fed it ideas, and you've given it a cool name, ProfitBot 9000. You're excited, ready to unleash it on the Forex market and watch the money roll in. But then, a terrifying thought creeps into your mind. What if it doesn't work? What if all that effort leads to a blown account in a matter of hours? Welcome back to the series, everyone. If you're just joining us, we're on a mission to build our very own AI Forex trading bot from the ground up. In our last discussion, we laid the foundational bricks, exploring the core concepts of what makes a trading bot tick. We talked about turning a simple trading idea into a set of rules that a computer can understand and execute flawlessly, 24 hours a day, 5 days a week. The goal is to remove emotion from the equation and let pure, logical strategy do the heavy lifting. But a strategy on paper is just that, a piece of paper. It's an untested hypothesis, a brilliant idea with no proof. Today, we're rolling up our sleeves and getting into the most important phase of development, backtesting. This is the part where we separate fact from fiction. We're going to take our theoretical strategy and put it to the ultimate test against the past. This series is designed specifically for beginners. So, what exactly is backtesting? In the simplest terms, backtesting is the process of using historical market data to simulate how a trading strategy would have performed in the past. It's like having a financial time machine. You can go back to 2020, 2015, 2010 and tell your AI bot to start executing your trading rules from that date on the following price data. The backtesting software then crunches the numbers, simulating every single buy order, simulating every single sell order. It's a safe, controlled environment where your bot trades with fake money, giving you a clear picture of potential performance. The whole purpose is to validate your strategy before risking real capital. Imagine the rule: buy year USD when the 50-day MA crosses above the 200-day MA. Run the crossover across 10 years in minutes, instead of waiting months or years. The software finds every crossover, simulates the buy trades, simulates the sell trades, applies exit rules like a take-profit target and a stop-loss level. Finally, it spits out a detailed report of profits and losses. This exposes flaws without financial pain. Maybe it works in a trending market but fails in sideways, choppy periods. A backtest reveals that fast. Maybe your stop-loss is too tight and kicks you out of winners. Maybe your profit target is too ambitious and rarely gets hit. Those are the critical insights backtesting provides. It's a diagnostic tool to fine-tune your engine before the open road. Ultimately, backtesting manages expectations and forces data-driven decisions. Now that you understand why backtesting is so critical, the next question is, where do you actually do it? Fortunately, you don't need a PhD in computer science or a supercomputer in your basement. There are several amazing beginner-friendly platforms that make backtesting accessible to everyone. TradingView, beautiful intuitive charts. Built-in strategy tester. PineScript for coding. One-click tests over decades of data. It's visual, easy to use, and a fantastic starting point for any new trader. MetaTrader 5, or MT5. Provided free by many brokers, MT5 comes with an advanced strategy tester. Test expert advisors. MetaTrader's trading bots. Use high-quality tick data for much more precise simulations. MQL5 is a bit more complex than PineScript, but the depth of analysis you get is top-notch. MT5 allows complex multi-currency pair testing and advanced optimization features, making it a professional-grade tool you can get for free. Quant Connect. Browser-based, open source, great for Python coders. Massive historical data, Forex, stocks, options, crypto. You can write your code backtest in their powerful cloud environment and deploy for live trading. The community is huge and very supportive, and their documentation is excellent. Perfect for those who want maximum flexibility and power. FX Blue. More of a trade analysis service, but its free trading simulator for MT4 and MT5 is an incredible manual backtesting tool. It lets you replay the market on a historical chart, allowing you to place trades, manage them, and move forward candle by candle as if trading live. Each of these tools has its strengths, so find the one that fits your style and start testing. Okay, so you've run your first backtest. The software spits out a long report filled with numbers, charts, and percentages. It can look pretty intimidating at first, like trying to read a medical chart without being a doctor. But don't worry, you only need to focus on a few key metrics to get a clear picture of your strategy's performance. Think of this as your bot's report card. The first and most obvious number to look at is the total net profit. This tells you the bottom line, After all the winning and losing trades, did the strategy actually make money? But profit alone is a dangerous metric to rely on, and we need to dig deeper. The next crucial metric is the win rate, often shown as percent profitable. This tells you what percentage of your trades were winners. A high win rate, say 70% or 80%, feels great psychologically, but it can be very misleading. You could win 8 out of 10 trades, but lose so much on the 2 losing trades that you end up with a net loss. Conversely, some of the most profitable trend-following systems have win rates below 40%. They lose small on many trades, but make massive gains on a few big winners. So, while win rate is good to know, it doesn't tell the whole story. This brings us to a much more important number, the profit factor. The profit factor is calculated by dividing the total money made on winning trades by the total money lost on losing trades. For example, if your bot made $10,000 on its winners and lost $5,000 on its losers, your profit factor is 2. 10,000 divided by 5,000. A profit factor above 1 means the strategy is profitable. A profit factor below 1 means it's a loser. Generally, you want to see a profit factor of 1.5 or higher. This number is powerful because it balances the win rate with the size of your wins and losses, giving you a much more accurate measure of profitability. Finally, you need to look at drawdown. This is arguably the most important risk metric of all. Drawdown measures the largest peak-to-trough decline in your account equity during the backtest. In simple terms, it tells you the biggest losing streak your strategy experienced. If your backtest shows a maximum drawdown of 50%, it means that at one point, your account was down by half from its previous high. This number tells you about the emotional pain you'll have to endure to follow the strategy. A strategy might be profitable in the long run, but if you can't stomach a 50% drop in your account, you'll likely abandon it at the worst possible time. A lower drawdown is always better. Once you have a baseline backtest result, the next step is optimization. Optimization is tweaking your strategy's parameters to find the most profitable and robust settings. For example, moving average crossover parameter. Size lengths of the moving averages 5,200. Stop loss value in pips is also a parameter. Optimization software can test thousands of combinations to find the sweet spot. Like turning dials in a sound studio, but tuning for maximum profit and minimum risk. Critical rule, never break it. Divide your historical data into at least 2 sets. First, the larger set, about 70 to 80%, in-sample notch training data. Use this to run optimizations. Software will churn through it and output the best parameter set. Example result, 42 period 188 period best profit factor on 2010-2019. Most people stop here, massive mistake. Second set, remaining 20 to 30% out of sample, JA, validation data. Keep it completely separate, not used for optimization. Think of it as a final exam. After you have your parameters from training, run one backtest on the out-of-sample data, e.g., 2020-2025. This is the moment of truth. If it performs well, you have evidence of robustness, not a fluke. If it performs poorly, that's a huge warning sign. It likely means overfitting to the training data. Always validate on fresh, unseen data before trading it live. We need to talk about the single biggest danger in backtesting: overfitting. This is a trap that has ensnared countless aspiring traders. Overfitting, also known as curve fitting, is when you optimize a strategy so it perfectly matches historical data, but then it fails in the real world. It's like creating a key that fits one old lock, useless on any other lock. The strategy looks incredible in your backtest, but it falls apart live because it learned noise, not market logic. A robust strategy shows decent, bumpy performance on unseen data. To avoid overfitting, keep your strategies simple. Before you risk a single dollar of your hard-earned money, you need a way to test your creation in a safe environment. You need to know if ProfitBot 9000 is a genius or a disaster waiting to happen. This is where the magic of backtesting comes in. It's like having a crystal ball for your trading strategy. Instead of blindly hoping for the best, you can simulate how your bot would have performed in the past. Would it have bought the EUR-USD pair right before a massive rally? Would it have shorted the GBP-JPY just before a steep drop? Backtesting answers these questions with cold, hard data, not with hopes and dreams. It's the single most critical step in your journey to building a profitable AI trading system. Skipping this stage is like trying to fly a plane you built yourself without ever testing the engine or the wings. It's a recipe for a crash landing, and in the world of Forex, that means losing your capital. So, before you even think about connecting your bot to a live brokerage account, you must embrace the discipline of testing. So, let's bring it all home. We've journeyed through the essential world of backtesting, the single most important step before you let an AI bot trade with your money. We learned that backtesting is our financial time machine, allowing us to safely simulate our strategy's performance on years of historical data. It's our shield against preventable losses, transforming us from hopeful gamblers into calculated, data-driven traders. Skipping this step is not an option if you are serious about long-term success. It's the bedrock upon which all profitable automated trading systems are built. We decoded the backtest report card, focusing on the key metrics that truly matter. And most importantly, we learned to read the story of our strategy through its equity curve, looking for that smooth, steady upward climb that signals a robust and reliable system. We also uncovered the professional techniques for making our bot better through optimization, while simultaneously avoiding the deadly trap of overfitting. With our backtesting complete and a validated strategy in hand, we are now standing at the edge of the launch pad. We will walk through the step-by-step process of setting up your AI bot on a MetaTrader 5 platform, connecting it to a broker, and preparing it for its first live trades. Subscribe for Part 5 next Saturday. I'll see you there.